Welcome to Herrick Does That, a podcast on current legal topics, relevant industry and legal trends, and significant developments in the law, brought to you by the attorneys of Herrick Feinstein. I am Belinda Schwartz, Herrick's executive chairperson, and I want to thank you for joining us.
Welcome back to Herrick Does That, where we pull back the curtain on how deals actually get done, how capital gets structured, how risk gets managed, and how operators, investors, and advisors navigate the real-world complexity of hotels. I'm Yariv Ben-Ari, partner at Herrick Feinstein, where I have the pleasure of serving as co-chair of both our hospitality practice group and our Israel practice group. Today, we're breaking down our ALIS takeaways. We're coming off of the America's Lodging Investment Summit, ALIS, one of the industry's premier gatherings of hotel owners, investors, lenders, and operators. My guests and I were there in the meetings, in the sessions, and in the hallway conversations. And today, we're distilling what we actually heard and saw on the ground. I'm joined by two wonderful people who I've had the pleasure of podcasting with before, Jonathan Falik and Evan Weiss. Good morning, gentlemen.
Good morning. Hi.
Jonathan, founder of JF Capital Advisors, works directly with investors, developers, and lenders to structure complex transactions and guide capital through volatile markets. Evan, founder of LW Hospitality Advisors, advises hotel owners and operators across the country on performance, strategy, and execution. He's in the data every day, in the assets every week, and on the phone with owners when decisions actually matter. Why don't you each give us a sentence or two about what your companies do beyond that, so we all are familiar with what you do for those who have not heard you before?
Sure. Happy to. Thank you, Yariv and Herrick, for having both Evan and myself on. Always enjoy doing this with you. We facilitate complicated hospitality transactions. In a lot of situations, we play outsourced transactional CFO, CIO, head of diligence, head of whatever needs to get done to make transactions happen. And with a lot of them, we're involved post-closing. If it's an acquisition, we're involved post-closing, oftentimes with integration, asset management for some period of time post-close. But even the cleanest of transactions these days have a bunch of hiccups along the way and have problems that need to be dealt with and resolved. So it's a tricky deal environment, but things are getting done.
Yeah, thank you, Yariv, for having us today. Always great to be here with Jonathan as well. Basically, we are a real estate services firm focused exclusively on the hospitality space. We focus primarily on evaluation, appraisal, feasibility studies, market studies, litigation, support, expert testimony. Jonathan and I overlap a little bit. He's a lot more of the deal focused and sort of very specific. We do a lot more third-party asset management, a lot of consulting advisory, help folks find brands and management companies and the like. So similar, but more of a focus on the valuation side for sure. We're a national firm, 40 plus people. We also have a data analytics platform called LARC, Lodging Analytics Research and Consulting, probably the industry's premier prognosticator for go-forward projections of average rate occupancy, EBITDA, cap rates, et cetera.
All right, let's start a little bit with just generally the overall mood at ALIS. I know that a lot of people couldn't make it because of the snowstorm. I just barely made it out there on the last flight out of JFK. How do you guys feel about the overall mood there? Were people more cautiously optimistic, euphoric, just thankful they were in warm weather? What did you guys feel like?
I felt very mixed, right? I feel like a lot of the deal folks were kind of just there reacquainting themselves with each other post New Year's. I definitely did not feel this sort of sense of this is going to be a big deal year, or what are you up to? What are you working on? Or that there's a lot of deals or transactions in play right now. Of course, there's always a level of deals in play. There's always a level of transactions. There's always a level of refinancing in capital markets. But generally, I think the mood, in my view, was a cautious optimism, but definitely a careful consideration as well. So there was definitely no negativity that I really saw. Not no negativity, but very little negativity. Much more sort of like stay the course. It's going to be a bit better than 25 from a transactional perspective. Operationally, going to be fairly weak year. Most markets expecting kind of like plus or minus 0% RevPAR growth with plus or minus 2 to 3 or 400 basis point growth on the expense side between taxes and labor, labor being a sort of huge focus. But again, a general sort of good feeling about the industry going forward, but nothing exciting or nothing sort of imperative.
I have similar takeaways. All of the industry projections, right, from Evan's colleagues at LARC, from CoStar, from others, project minimal RevPAR growth. And when you parse through it, a lot of that RevPAR growth for 2026 is expected to be driven by FIFA and by the 250th country anniversary celebrations and events. If you peel that out, RevPAR growth is generally pretty flat as an overall industry year over year, while labor costs are going higher, operating costs are going higher, fixed expenses like property tax and insurance are going higher. So the theme was really 2026 should be less bad than 2025, which is not a compelling thesis for acquiring hotels, for building new hotels. As a result, the folks focused on debt financing and debt origination seem to be a lot more active than the sell side investment brokers, because a lot of people that can't figure out how to sell their property and have a maturing loan are going to go into the refinancing market. And we found for the most part, the refi markets, the debt markets are fairly strong, fairly good, though underwriting is challenging.
So when we're talking a little bit about underwriting and some of the other things you mentioned FIFA, labor costs. We certainly have a lot of activity around the country at the moment, but was there any discussion over both geographical concerns and market segments? Which hotels, is it full service, select service, extended stay? My question is in two parts. One, let's talk a little bit about geography around the country. Are there areas that used to be more favorable, now are less favorable, or vice versa? And a little bit about what segments are doing better than others.
So basically, when you look at different market segments, luxury has been performing quite well. Higher end group has been performing quite well, and those are projected in most markets to continue very strong, right? There's a big disconnect between luxury and almost all of the other sectors, including budget economy, which are losing ground. There are a variety of reasons posited for this, but if you look at the stock markets, you look at kind of GDP and what's driving GDP growth, right? A lot of it is concentrated in a small portion of, or relatively small portion of the population. In terms of markets, there are some markets that are quite challenging. There are some that just have been much slower to recover, like San Francisco is seeing a whole lot more activity. There's still concerns about safety. There's still concerns about how quick it recovers. But 2 years ago, no one wanted to touch San Francisco. Now you're seeing smart money, buying into the San Francisco market. There's a lot of caution around Los Angeles, and it's a little bit safety and ICE related, but a lot of it is how the city is choosing to create legislation to do things that the labor unions can't. So pushing to $30 minimum wages, pushing to legislating how many rooms a room attendant or housekeeper can clean. Similarly, in New York City, the underwriting is extremely challenging right now because the labor union contract resets in the middle of the year and no one has enough guidance on what that will do to wage scales, to work rules, to benefits, and everything that goes around that. So it's difficult to have a lot of conviction in your New York City underwriting. You can make a lot of guesses and run sensitivities. That said, there is market activity in New York City, just the underwriting is a lot less certain than it might have been even 2 years ago when it was uncertain.
Yeah, I would generally concur with Jonathan's assessment. I mean, I've been saying for the last 2 or 3 years that I love the barbell markets, right? I love the super high-end luxury resorts, and I like the super low-end, economy extended stay specifically. And the reason is fairly straightforward. The middle is purely commoditized, right? I'm not going to name brands, but select service, limited service, I'll name them all. Hampton, Holiday Inn Express, Fairfield Inn, whatever it may be, they're all so similar. And really, ultimately, within a market, if they're roughly the same age or roughly the same vintage of CapEx, you're really just competing on price in a very, very specific location, but really on price today. Because things like visibility and accessibility that mattered, 25 years ago before Weiss and GPS devices really don't matter today nearly as much. You pop into your GPS, it's an extra 2 turns, but who cares? It's being given to you, right? Or it's right off the highway, not on the highway. It doesn't really matter anymore, quite frankly. That being said, why do I like the upper end? I like the upper end because there's levers. First of all, not politically correct, but rich people getting richer. That's just a matter of fact, right? People that we know that make 7 figures, 8 figures, they're making even more than they ever have, generally speaking. And you know what? Do they like paying $1,500 a night for a resort or a luxury urban property that just 5 years ago was $1,000 or $800? No, they don't. Can they? Yes. Will they? Yes, because their significant others or their group is deciding that that's what they want to do. Additionally, again, like I said, there are levers: food and beverage, spa, programming, activities, whatever it may be, another food and beverage pop-ups, ice skating rinks, whatever it may be. There's always more levers to pull and therefore add more revenue. On the bottom end, you're talking about a facility of 100, 150 keys that can have somewhere between 5 and 8 FTE, full-time equivalent employees. So where labor is so important, the truth of the matter is that those economy extended stay assets that cost $125 to $155 a key to build really can have RevPARs that are almost similar to those assets in the middle of those select service or limited service assets that cost $180 to $250 a key to build. And so you have a lower development cost, quicker time to market. They're generally built in markets. They're built on slab. Then they're built in markets that you can probably from inception through opening could be 24 to 30 months as opposed to 36 to 48. Right? So you're getting it out there quicker. You have less money spent on financing and construction costs, and then you're cash flowing much sooner and they fill up much quicker because there's a lower price point. And again, you're operating them much more efficiently because you're typically 5 to 8 FTEs, full-time equivalent employees. So I think that could be profitable as well. Now you've seen some profitability and some occupancy and things like that decline on that lower end property as of late. But I think that's just due to kind of an influx of new supply. But once that dynamic sort of evens itself out, I think that they'll be back to performing quite well. So generally, I agree with that sort of overall sentiment. The other aspect in terms of markets, completely agree. I think union markets to me are somewhat uninvestable. LA is uninvestable. The 5.5% mansion tax, the safety and security issues, the fire issues, the lack of governmental oversight or the over-governmental oversight and the lack of government ability to help their business owners make money. None of that makes sense to me. And that's why you're seeing there's essentially a no bid on Los Angeles. There's very few transactions, if at all, on any level of the spectrum, high to low, luxury to economy. Places like New York, I was on a conversation yesterday with a lender that was looking at a 4-pack of about 1,000 rooms in the city, all full service, kind of 3.5 to 4.5 star. And I said, you have the worst assets possible. You're not low enough end where you can just crank through occupancy and average rate and RevPAR and lower your headcount. You're not luxury enough where you can push rates past $450, $500, and they're all union. And so the union is just eating their lunch. Now they're making money now, but what happens with the new union deal where they get somewhere between 6 and 10% compounded annual growth on their wages, and no one even knows what's going to happen to pension and benefits. And that's not just a New York issue. That's not just an issue that's germane to New York. That's germane to every union market in the country, which are a lot of major urban high-end markets. And as Jonathan, I'm sure, and Yariv, you know well, the unions are looking to unite here, pun intended, to have a role of the union agreements all concurrent with one another. LA, Philly, Seattle, Chicago, New York, et cetera, all roll at the same time to have maximum leverage on the owners and on the operators. That is a potential death knell, frankly, for a lot of hotel owners, mostly owners. Operators, frankly, care a little bit less. And so a lot of those markets to me is a no bid situation. And I don't know what it's worth. I mean, to build a new full service 4-ish, 3.5, 4-star hotel in New York City today without residential, without municipal assistance or any kind of tax abatements probably costs you about $1 million to $1.2 million a key, inclusive of land, right? That hotel, when it's done, is probably worth, if it's again a 3.5, 4 stars, probably worth $500,000 to $600,000 a key. I'm not great with math, but that don't work. So
well, I'm pretty good with math, and I can confirm that doesn't work.
Yeah, thank you.
I would add just a couple more points to provide some context. And one is the hotel industry that we work in and that we love has consistently ceded occupancy historically to the OTAs and over the last 5 to 10 years to the short-term rentals business, where in a lot of markets we're seeing occupancy not even recovering to where it last peaked last cycle because there are lots of rooms in certain markets in Airbnb and other short-term rental providers. And what the short-term rental providers has done, what Airbnb and VRBO and others have done is they've turned every host into a super sophisticated sales agent. If I'm thinking about getting a hotel room in Denver, I can call the hotel and I'll get someone who answers some basic questions. If I'm thinking about renting an Airbnb in Denver, the host is going to respond within an hour of me sending over any text or any message or question. Tell me exactly what the Wi-Fi speeds are, if the pool is heated, what's happening, how close a supermarket is, how many cars can fit in the driveway. So they've basically harnessed outside labor, right? Airbnb has harness their hosts, which is essentially outside labor, to sell and market the product, right, and bring people over the finish line. Another thing that we're not really paying so much attention to because everyone focuses a lot on RevPAR growth, and it's the easiest measured. All of the asset managers out there and all the owners out there and a lot of operators have focused in the last however many years in really pushing F&B revenues higher, in adding meeting room rentals and adding resort fees, destination fees, which I know we're going to talk about, in adding parking charges and figuring out how to grow non-rooms revenue. And that all sounds good, but at the end of the day, whether hotel guests know it or not, many of the hotel guests are looking at the total amount that they're paying, not just what's the ADR, right? And as a result, it's sort of putting a little bit of downward pressure on the ADR because someone knows, well, I'm going to also be paying this resort fee or destination fee. I'm also going to be paying $55 overnight for parking in many urban markets. I'm going to get charged a fee for X, a fee for Y, and a fee for Z, and that has an overall impact. The last thing that I would say is when you look at the measurable public hotel universe, if you look at the REITs, which are the real estate owners, their EBITDA margins today are roughly 350 basis points lower than they were in 2019, right? Because of all the things that Evan said, increased labor costs, right? Increased wages, increased benefits, increased property taxes. So even though they're doing a good job asset managing and revenue managing, they're down about 300 basis points, while the C Corps, the brand companies like Marriott, Hilton, Hyatt, IHG, are roughly a little more than this, but over 1,000 basis points higher. So more than 10 percentage points higher in EBITDA margin than they were in 2019. So they're getting bigger, right? They're getting more profitable, and they're getting more profitable, right, from a bigger base of owners.
I mean, just look at the market caps. I mean, Jonathan, I pulled this from your public comps report, little JF Capital plug there. The market cap of all the hotel REITs combined is like $65 billion, or that's the enterprise value. That's the enterprise value. And the enterprise value is $100 billion, and Hilton's like another $80 billion. The numbers are dramatically different. It's a very different business. I always say this: Hilton, Marriott, Hyatt, all these companies, maybe not Hyatt. Hyatt's a little bit different, but Hilton, Marriott, et cetera. These are not hotel companies. They are marketing, distribution, and sales companies that happen to be focused in the hospitality space. They really don't own. Management is a relatively small component of their EBITDA. And of their 9,000 hotels, what does Marriott own? 1, 2, and they're strategic and being ready to be sold off. And they manage 5, 6, 700 maximum. So it's the way it is. And I personally don't think that there's a whole lot of light at the end of the tunnel in terms of margin, because I think that the general public, economically speaking, is hitting sort of a ceiling in terms of the rate. Like, how many nights a year can a Hilton Garden Inn in Manhattan that was built 15 years ago, that has a room that's 190 net square feet, or a Marriott product or an IHG product or whatever it is, how much longer can that asset obtain a $450 average rate? And where is the ceiling? I think we're about to hit the ceiling. Personally, I think it doesn't matter that there's very little new supply coming to New York City over the next decade because of the laws that were issued here. So I think that's going to continue itself around the country. So I think you're going to hit a rate ceiling. So your revenues are going to hit here, and your expenses are going to continue to creep up because nobody really cares about them. And so either A, hotels that once traded for $600,000 a key become $300,000 a key, or B, there's no bid. And the investor universe just says, you know what? I'll pivot to multi, I'll pivot to industrial, I'll pivot to self-storage. You know, if SFR exists in a month or two, maybe I'll pivot to that, right? But how do you bid on such a dynamic industry that you don't control the bottom line? My whole thing, not to get on a rant about unions, but my whole thing with certain types of labor operations is, if you have the best hotel and the best location, the best management, the best people, the best processes, the best expense costs cutting, et cetera, you could still potentially make no money. How's that possible? Because somebody else controls your bottom line to a significant extent. Now, obviously, that's a bit of an exaggeration, but not entirely. So that's sort of my challenge with that situation going forward.
So, Evan, the public markets have already come to that realization. So REITs are trading at, depending on how you look at G&A or not, at somewhere between an 8.5% and a 10% cap rate. In the private markets, it doesn't look like that. If you look at enterprise value to EBITDA multiples, and just wind back the clock a little bit, the public hotel REITs were trading at 13, 14 times enterprise value to EBITDA. Now they're trading mostly kind of, at around 10 or inside of 10 times EBITDA, which is a big reduction in value. Now, some of that has to do with lower growth expectations, right? They're not projecting any meaningful EBITDA growth. Some of it is a function of higher interest rates, right? That the REITs were enjoying low interest rates for a while, but now rates are at a much more normalized level, even though people think interest rates and borrowing costs are high. By long-term historical standards, they're not, right? By standards of 2009 to 2022, they're quite high.
I don't disagree. I mean, I think debt is not the issue today. My understanding is if you have an asset that's cash flowing at roughly a 10, 11, certainly 12 to 14 debt yield, I mean, you're getting quotes 225 to 275 over SOFR. I mean, you can borrow at 6.5% today. To your point, Jonathan, historically, that is super accretive debt and extremely reasonable. And I think anyone today that has a good asset, I mean, frankly, even on construction deals, you're getting sub 10% debt today, even sub 9% in some cases. We're seeing SOFR 300 deals all day long, 350 even, right? So you're talking about sub 7.5%, sub 7% debt on a fairly typical basis for good quality assets. And even ramping assets, you're talking about 8% debt all in. And so whether it's fixed or variable to the SOFR. So debt is really not preventing deals today. It's really cash flow, future cash flow, control of expenses, control of labor, where property taxes are going. These are how you can push RevPAR in an environment where the economy is a little bit uncertain. Tariff situations made nobody much happier. The immigration situation is a challenge right now. And frankly, the visitation situation with visas and all that is also scaring a lot of international visitors. I mean, I'm a little bit skeptical. This is purely a thought. It's not data based. I'm a little bit skeptical that World Cup is going to have any real major impact in many markets. There'll be a few markets that fly because of it, maybe like New York, but LA got a pretty crappy draw. How many people are going to stay in Kansas City for more than a night or two, right? The question really is what the true impact of World Cup is going to be on the U.S. And then on top of that, layer in $250 visa fees and the international fear via the media, whether it's real or perceived, of being held at the airports for hours on end. I mean, I don't know. We'll have to see where the administration goes and what that ends up being. But for me, when people talk about World Cup as a reason to buy a market, I think it's crazy town.
Well, part of why it's crazy is that's a one-time non-recurring, right? So you might have 6, 7 matches in one city, but that's one-time non-recurring. So the following year, you're likely going to see a dip, which is sort of what everyone who was benefiting from the Taylor Swift tour saw. Like what we really need for the industry is a whole lot of technology to replace humans. And we're not there yet. But if you look at a typical hotel, right, the biggest operating expense by far is labor and benefits. So if we can have robots cleaning rooms, if we can have robots like cleaning the buildings, doing laundry, chopping vegetables, doing things like that, that's where we'll be able to reclaim margin in the industry. But we're still a ways away from that. And the markets that do have heavy union labor will be fighting like hell against robot technology because it will displace jobs.
Do you guys think, and I saw this weekend, I was actually away for my wife's birthday. I took her to the Caribbean, and something that surprised me a little bit was the amount of the ultra high-end cruise ships that were coming in, not like the Ritz-Carltons of the world and so forth that I saw them coming in. And I was surprised. The island I was on, I expected the hotels to be packed, but they weren't. There were more people coming off these 500, 600, 700 person cruise ships, not the 3,000 ones, right? Coming onto the island with the boats, spending the day there, shopping and everything. They cleaned out all the retail stores, and this was high-end. And then they kind of left for the night, and they were going from island to island. And I'm assuming that these labor costs and a lot of the other costs are much cheaper for these cruise ships. Is that something we'll see more and more in terms of the tourism travel that will replace going to some places like, I don't know, instead of going to LA or Miami, people will start traveling more like that?
I don't think it replaces. I think it is definitely an expanding trend. When Ritz went into it and then when Four Seasons went into it, I mean, they're basically building luxury resorts on the water, which is incredible. And so because they're relatively small, I don't think that they replace, but they certainly are another option for the luxury traveler. I mean, if you go on a Ritz-Carlton cruise for 7-8 days, I mean, you're talking about $20,000, right? For a room, for a double occupancy. And so here's what I think overall, it's actually interesting. Usually when the cruise industry ticks up, it means there's economic issues, meaning because that traveler, instead of taking a flight and then an hotel and activities, they want it all inclusive in one, and they perceive it. In many cases, it is a more affordable quality vacation. But you're talking about a different travel. I happen to think a lot of it is also the newness of it, for lack of better terminology. It's new. This is really a 5-6-year-old situation, other than like river cruises on the Danube, with Viking, this sort of large scale cruise ship of 3 to 5, 6, 700 people, a Four Seasons or Ritz-Carlton quality is really new. And I think it's going to become an option and a slot in, frankly, for that traveler, right? I don't think that they'd stop going to Cabo and staying at the Ritz Reserve or going to the Ritz Reserve in Dorado or going to the Four Seasons in Anguilla. I don't think they stop doing that. I think that of their 4 vacations a year, one of them may be on one of these cruise ships for that caliber of people. But it's funny because generally speaking, cruise ships tick up when the economy ticks down because of that affordability factor. And in this case, it's sort of just a trade-off. I don't think it is a demonstrably negative effect on the luxury hotel resort market in luxury resort destinations.
What it does do, Yariv, what it does do is it gives additional optionality and creates some additional theoretical supply. So anything that whittles away, and we saw this when Airbnb started and then grew, anything that creates something that pulls some of your occupied room nights away from the hotels that you're looking at, right, has downward pressure on the hotel. And sometimes you might get to the same occupancy in the hotel, even though there's more competition out there, but you get there in a different way. You might become more reliant on OTA or on some discounted business to fill up. You might be filling up in the week for the week, in the day for the day, instead of having more business on the books a month out, 2 months out, which allows you to better revenue manage and yield higher ADRs for your remaining inventory. It is a competitive factor. To Evan's point, it's not big enough that people take it as a serious threat, but it is something of a serious threat because it's going to grow. The other kind of observation on the cruise industry is for most of the cruise industry, they run at like 99% occupancy. Right? They have very high fixed costs. They use the rates for the rooms that people pay to essentially offset their fixed costs, and then they make their money and they make their margin on the additional upsells on board and on the excursions when people are leaving. So if you go for the premium dining, if you get the extra Wi-Fi package, that's where they make their money. But like the actual price of the cabin offsets their fixed costs, which are high.
Yeah, and I would say it's actually interesting when you really think about it and you kind of do a little bit dive. They're really cannibalizing themselves. Personally, I don't think it's any different than Four Seasons adding a hotel in St. Thomas, Anguilla, and St. John, right? Meaning they'll put a hotel in any market where they believe it works, and they're not really thinking that it's cannibalizing themselves. And I think this is no different. This is just another option for their traveler to spend money with their brand and to further increase the value of their brand to their customers.
So going back a second to ALIS, there was a lot of talk about AI and technology, how people can use AI to better manage the entire process and the revenue side of the hotels. What is your take? Because a lot of discussions I had, at least on the law part, were if you're going to use AI to replace junior help, by way of example, well, who's going to train that junior help? So taking that correlation, if you're going to start using AI without having to replace, I think, Jonathan, you mentioned earlier, to replace some humans, how are people going to learn how to run these things long term, manage them, understand, the bricks and mortars of the business? What are your takeaways on AI, and what did you hear about it at ALIS?
I can give you the sad reality first, and that is there's talk about it everywhere. The hotel industry, right, that we work in and we love and enjoy is notoriously bad at adopting new technologies quickly and efficiently. And part of this is a function of the disconnect between the brands, the management of properties, the owners of properties, and all sorts of other service providers out there. So while there's a lot of talk, we've been using AI in revenue management for, 2 decades. I can't think of a single hotel that I'm working with or have been working with where we said we can replace these 3 people because we're using some sort of AI tools. We are using some in some places to make labor management more efficient, like better staffing, better projections of what our occupancies will look like so we can staff better. We're using AI a little to inform F&B pricing for banquet and catering business. But from my perspective, where I sit in the industry, there's a lot of talk about it, and it's not really moving the needle for us yet, while I know that Airbnb, Expedia, Booking.com, Amazon, Google, they're using AI like left and right. Because if we got off of this podcast and I called you, Yariv, and said, hey, I think I want to go to Hawaii, somehow magically I'd be getting pinged from Expedia, or things will be popping up on my Instagram saying like, ready to book your trip to Hawaii? Like Maui's great this time of the year. They've got it and understand, and our people on the outskirts of the industry are way, way, way ahead of us.
Yeah, I mean, again, Jonathan said it exactly right. The real estate industry in general is awful at technology adoption, and the hotel industry then falls below them in terms of technology adoption. So we're pretty bad. And in addition to that, we also have outside factors working against us. Like, hey, we're going to replace all housekeepers in a decade from now. By 2036, there will be no more housekeepers, right? Guess what? That's not, if that happens, that will be the biggest brawl of the century, because housekeeping is the main sort of earner for labor unions, right? Now, by the way, the technology exists already for a robot to walk into a room and do most functions. And they're working on the idea that the robot can lift up your toothbrush, wipe under it, and put it back down. Think about the technology and the AI behind that and the actual true artificial intelligence there. That's probably available in mass for like an affordable rate within the next 5 years. How quickly does that get adopted? I don't know. I think you're going to see robots in a Hampton Inn in suburban Kentucky before you see it in urban markets, which is kind of pathetic, but also super true, because those hotels are owned by true entrepreneurs who just want to make money. And listen, that's the way of the world. One of these media guys, Gary Vaynerchuk, said something really smart, and I liked it. He said, you will not be replaced by AI. You or your employees will be replaced by people that know how to use AI. And I think that's the key, right? Sort of adapt or die. And I'm a big proponent of that. To Jonathan's point, we've been using AI and to some extent in BI and revenue management for 2 decades is probably about right. And there's no reason why half the employees in a hotel can't probably be replaced within the next year. Not to mention the fact of like property maintenance programming that should be super affordable. And so you need 1 engineer instead of 5 and all these different things. It's not just robotics, right? It's just, it's predictability. It's customer acquisition. You're cutting down all those costs. At some point, there are companies out there like Casa, KASA, that are working with AI bots. So Casa has about 50% of its inbound customer service calls are handled by AI. And the system is so smart at this point that it knows which ones are simple and they can respond with AI, and which ones have to get transferred automatically, by the way, to an agent. So they've cut off, let's say, 50% of that group. And the way that they've trained the AI with human voiceover, et cetera, and the responses that they're given, which are thoughtful and better than a human in most cases, more comprehensive. And even with like the pause of a human and the delay of a human and all that, they're getting higher quality responses, higher customer quality responses and guest service responses than they would have otherwise. So things like that are already happening, and the smarter companies out there are focused a lot. Listen, the revenue side, I think, is kind of there in a lot of ways. It's really the expense side that's going to have to really adapt, and companies like that and other similar companies that are focused on the expense side are going to win the day. And I think there's no reason hotels shouldn't have 40+% margins other than maybe luxury, and luxury could have those margins by the ability to charge more. Right. Whereas the select service, they have to implement technology because their rate ceiling is already getting hit.
I have kind of my wrap up question. Usually I ask the crystal ball question. What do you see in the next 12 months? But I want to kind of look at it a little bit differently, because I don't think where we are right now, we can really use a crystal ball to see what's happening. If you were planning a conference like ALIS in exactly a year from now, okay, what are the topics you would be really focusing on now to talk about in 12 months from now? What should people really be mindful of, guys?
We go to all the big conferences, right? You know, we're guilty of speaking at a bunch of them. The reality is very few people are getting up on stage in front of like hundreds of people or 1,000 people and, you know, sharing industry trade secrets, right? So they're good gathering places, good places to get a sense of like what the overall sentiment is, good place to connect with industry colleagues. If I was picking topics for a new hotel conference a year from now, I would want to know what techniques and what tools are people using to make labor management far more efficient, right? Whether that's AI or otherwise, what are they using and doing? And I would also like to really understand, and we don't spend enough time on this, how the kind of competitors to the hotel industry itself are taking away our business, right? What Airbnb and short-term rental companies are doing that we're not doing, what Expedia and Booking.com are doing that we're not doing, and how they're taking our business. Same with cruise and like how others compete with us. We spend a lot of time talking about how great we are and how wonderful we are. And I'll admit some of the people in the industry are great and wonderful, and some are not so great. Some are not so wonderful. But what are our competitors doing? Right. And how are they eating our lunch?
Listen, I think Jonathan's on the right path. It's interesting. Everybody's been talking about AI. I think people are less focused on BI than they should be. Business intelligence. Yes, AI can help fuel BI, but it's like, how much water did we use last year? What did it cost us? What did it cost us this year? How much electricity did we use? What did it cost us? What does it cost us this year? Of course, labor, but getting nitty gritty on labor. How many servers did we use in the dining room? How busy were we on average Tuesdays in February for breakfast, lunch, and dinner? What did we do in the interim? What did those people do in the interim? Now, granted, that sounds like a lot. It sounds super complex, but candidly, between AI and utilizing that in a BI sense, that stuff should be able to be programmed within 6 months to a year, and then just rinse and repeat it. Just input the data. And so I think we don't, as an industry, focus enough on the business intelligence aspects that allow us to really enable ourselves to make money. And a lot of that is thwarted by organized labor, and that has to stop. It has to be a business for business. It has to be a for-profit business, and we need the ability to make as much money as we possibly can. Obviously, treating people fairly and paying them fairly, of course, but at the same time, utilizing BI in a much more specific sense. So I would say topic-wise, I think, again, we focus so much on RevPAR and growth and all this stuff. But again, if your RevPAR is growing 2-3%, which is average, right, and your expense line is growing 300-400 basis points, guess what? You're losing money and you're losing the battle. And so I think there has to be more focus on that side. How do we actually make money, and where can we focus that we can actually make more money?
So with that, I want to invite all of you back in a year from now, when we will hopefully do this again and find out how we made money and not lost money. Thank you, Evan. Thank you, Jonathan. As always, your insight is amazing. Thank you, everyone, for listening in. Until next time, this is Herrick Does That. Goodbye.
Thank you very much for joining us for Herrick's podcast, Herrick Does That. To learn more about our firm and to listen to additional podcast episodes, please visit us at www.herrick.com.